Navitas stock is up over 300% this year and nearly 500% in the last 12 months. But here's the real question. Can this momentum actually last, or is the stock going to come crashing back down to earth? Because what I'm seeing in the numbers doesn't really match up with the hype. Revenue is down 29% year over year, and losses per share doubled. And yet the stock keeps ripping higher and higher. Think that kind of disconnect, it cannot last forever. I mean, Navitas isn't some meme stock. It's a pure power semiconductor company that's betting on gallium nitride and silicon nitride, the tech that powers things like EVs, chargers, solar, and even data centers. And then their GaN fast power ICs, they're said to charge 3 times faster in half the size of a traditional chip. But I think there's something bigger going on here, because when Navitas just partnered with Nvidia, the stock exploded 25% overnight. And I think most people completely missed why that move matters. In this video, I'm going to show you the one signal that I'm watching that could tell us if Navitas is building a sustainable moat, or if this run-up is just all smoke and mirrors. Hey, what's up, everyone? My name is Rick Orford. I have been trading since 1999, and no, I am not a financial advisor. That's a good thing. I break down the numbers so retail investors like you and me can make smarter, more confident decisions with our money. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to fool.com/RickO to get your 10 stock picks right now. With all that out of the way, let's get started. Okay, so I'm going to first break down what's really driving Navitas and whether this stock deserves a place in your portfolio. Navitas is a pure power semiconductor company. They make gallium nitride and silicon carbide, or GaN and SiC-based technologies. These technologies are used to charge many products, from electric vehicles and mobile phones to industrial machinery and even data centers. In other words, if it runs on power, Navitas probably touches it at some point. And here's the thing. Semiconductors, well, they're the backbone of every single mega trend right now. And Navitas is betting on being that picks and shovels supplier for that growth. So while everyone is chasing the next AI stock or EV play, Navitas is quietly building the tools that all of those companies rely on each and every day. Now, one of their main products is the GaN fast power integrated circuit. And if you're unfamiliar with integrated circuits or ICs, they manage the control of flow of electrical power within a device. And they can be found in practically anything from your bedside phone charger to those massive data centers that power practically our entire modern world. The GaN fast power IC, which uses gallium nitride as its base, allows for 3 times faster charging in half the size and weight of a traditional silicon-based chip, with up to 40% better energy efficiency. So what does that mean in English? Well, it means that devices charge faster, they waste less energy, and manufacturers save space, all while reducing heat and improving reliability. These power ICs are used in mobile chargers, laptop chargers, data power supplies, solar inverters, and even electric vehicle. So you could say that Navitas isn't just chasing one trend, they are plugged into all of them. Navitas also expanded its offerings from only GaN-based technology to include SiC-based technology with the acquisition of GeneSiC Semiconductor. This was a pioneer in silicon carbide technology. That move, it wasn't random. It doubled Navitas's total addressable market almost overnight. GeneSiC held patents on wide band gap power device technologies, including MOSFETs and diodes. Now, in case you didn't know, MOSFETs are a type of transistor that uses an electric field to control the current through a semiconductor. In other words, they're used as switches to control the flow of power to semiconductors. Silicon carbide MOSFETs, well, they have a higher blocking voltage and higher thermal conductivity than traditional silicon MOSFETs. And that translates to faster switching with a more durable material, making it more efficient than those traditional MOSFETs. Basically, less heat, more speed, and better power management. And that's exactly what the EVs and data centers crave. These MOSFETs are mainly used in EV chargers with GaN power ICs. And that combo, GaN and SiC together, could be Navitas's real edge. It's kind of like pairing speed with endurance. All right, so let's talk about the company's stock price, because the last time I reviewed Navitas, it was trading at $8. Now the stock is trading at around 14, almost double what it was last time. So if you got in early, congratulations. But here's where things start to get interesting. The stock grew more than 25% after Navitas issued an update on its partnership with Nvidia. If you zoom out a little, Navitas has been performing well overall. The stock grew 317% year to date and 482% in the last 52 weeks. That's not just growth, that's breakout momentum. But momentum, it can cut both ways. Previously, I discussed the risks associated with investing in Navitas in this video up here. And I also talked about the catalysts on my Discord channel. Now, for now, let's talk about the financials. Navitas is set to report its third quarter 2025 financials soon on November 3rd. Before dissecting that, let's have a look at their performance in Q2 and management's expectations for Q3. Navitas announced their second quarter financials on August 4th. Revenue dropped 29% in Q2 2025 from that in 2024. Net losses per share more than doubled from 12 cents a share to 25 cents a share. That's not exactly encouraging news that shareholders want to know about, because when a company grows its losses faster than revenue, well, we ought to be asking those tough questions. But if we look into their expenses, though, Navitas' biggest expense is R&D. It makes up 44% of its operating costs. And total expenses decreased by almost 32% compared to last year. And that proves that Navitas is managing its operations as best as they can. It's really worth noting because R&D heavy companies they often bleed early but lead later. Meanwhile, third quarter guidance puts revenue at around $10 million. For reference, last year's third quarter revenue came in at $21.6 million. If that comes true, that would represent a 54% drop year over year. That is steep, but sometimes short-term pain signals a long-term pivot. We'll have to see. So is Navitas stock a buy at these levels? Well, to answer that, let's see what Wall Street says. A consensus among 9 analysts rate Navitas a moderate buy with an average rating of 3.44. This is likely because the stock has already exceeded its $8 high price target. Analysts call it priced in, but that's exactly when those contrarian investors start to lean forward. I've learned that when the consensus gets too comfortable, that's when opportunity tends to hide in plain sight. It's a classic high growth, high risk setup, the kind that either makes your quarter or tests your conviction. But what about you? What's your take on Navitas? Are you buying or holding or just watching from, the watch list? Let me know in the comments below. And while you're there, don't forget to like and subscribe if you found this video useful. It helps others find the video, it supports the channel, and of course, you won't miss out on any of my future deep dives. Well, folks, that's it for me today in this video. I wanted to thank you so much for watching, and I'll see you next time.